Sorry, just the couple things about the business combination, and some of you could ask, well, why does that matter to me? Well, why do I care if it's a business or an asset acquisition? And one of the reasons why it's important, and we've seen that in a number of examples, is that the Securities Commission is coming back on a lot of deals right now, and they're saying, well, we think you have to file a business acquisition report. Okay, so they're viewing a lot of the acquisitions recently as businesses, and there isn't necessarily a direct correlation because IFRS is coming, but because the definition is expanding, okay, for accounting purposes, then the regulatory bodies are also viewing a lot of these mineral company deals or a lot of startups, whether they're being in mineral properties or technology or whatever it might be, as businesses. And if you have to file that business acquisition report, that means you've got to get audited statements of that business. So, you know, historically it's been nice because we've always called them asset acquisitions, and then you just consolidate the assets. But if you call it a business now, then you got to provide audited statements probably for 1 or 2 years of that business. So that first point is important in terms of regulatory compliance, et cetera. And the second part is that under the new rules, okay, if you're acquiring a subsidiary, that if you're acquiring if you're acquiring a subsidiary at 100%, it's the same accounting under Canadian GAAP and IFRS. There isn't any difference. It's only when you're acquiring less than 100%. So if you've got what we call a minority interest. Okay, so you know, some of you here are accountants, but under the old rules, the way it used to work is that you used to consolidate the subsidiary based on the percentage that you own. Okay, so if you own only 70% of something, you consolidate everything based on what you paid, okay, $1 million, and then you have the minority interest to offset. Okay, under the new business combination rules, if you have minority interest, you account for it under fair value. Okay, so for example, if you paid, you know, $1 million to the property, plant, and equipment, but you only acquired 50% of it, then really what you're saying it's worth $2 million. So under IFRS, you're going to call the property, plant, and equipment $2 million, not just $1 million, and then your minority interest balance is just going to be that much greater. So that's really the big difference between Canadian GAAP and IFRS. Not if you have a 100% subsidiary, but if you've got this minority interest situation where you're accounting for the assets and liabilities under what they call the full parent consolidation view. Okay, so business combinations, if less than 100%, will have significant differences. And just as important, it's because that definition is broadened that you'll have to likely provide more audited statements of the businesses you're acquiring. Just as a quick example, we have Australian counterparts who, you know, recently acquired a mineral property in Australia, and we look at it and we go right over, we go, well, of course it's not a business, you just acquired some exploration claims. And they're of the view that as long as you're buying a company, it's a business. Even if it, you know, and I said to them at the time, well, what if that company only had a table? You know, is that a business? And they would say, well, yeah, it's a business because you bought the company. So, you know, some countries are really looking at a business as everything. Whereas for mineral properties, under IFRS, there are still some guidance out there that not everything is a business. But if you are a mineral company and you've got a plant, or, you know, you set up camp, or you've got these kind of assets that indicate that you're doing more than just basic exploration, that could very well be seen as a business under IFRS. So those are just some of the implications practically.
Yeah, it's definitely something you need to look at. So asset acquisitions, so these are acquisitions of companies that do not meet the definition of a business. As we mentioned, you know, in many cases that's sort of the route a lot of you have gone with the acquisitions that you've had. I'm just going to jump to the last point, and I'll go back, but this is a point that will definitely affect likely most of you. If you've acquired a business in the past, you know, like I've said before, let's say you acquire a Mexican subsidiary that has a property and so on. You know, you've looked at it, you go, okay, it doesn't meet the definition of a business, it's an asset acquisition, and you apply the accounting that goes along with that. One of the items that you've had to book is an FIT liability. And the other side of that liability has always gone to your mineral properties. You know, you bring over your assets and liabilities, and you've got that FIT bump up. and then the remainder goes to mineral properties. So let's say you did this acquisition, because you really do need to look at most of the, not all the acquisitions you did, but I'm going to explain sort of how you need to go about it. Let's say at the transition date, you have an FIT liability still on your books, and that FIT liability was as a result of an asset acquisition that you did in the past, then you need to adjust for that and basically get rid of that liability if it relates 100% to that acquisition. Okay, that'll be an adjustment. And the other side of that would be mineral properties, because that's where you put the other side of it to begin with. Okay, because under IFRS, you do not need to record that FIT bump up. Now, you might have the situation, though, that you had an asset acquisition in the past, and at the time, you booked an FIT liability, and you put the rest of the mineral properties. But over the years, that FIT liability will get ground down by any losses that you've had. So at the date of transition, there might not be an FIT liability there. Okay? However, it might still be sitting in your mineral properties. Okay, so if you've acquired a property and that bump up, whether it be 2 years ago, 5 years ago, whatever, if that other inside went to your mineral properties and it's still sitting in there, then you need to reverse it and take it out. Okay, so the way to do that is you want to look at your capitalized mineral properties, right, at a transition date. Look at your acquisition costs. And you need to sort out what makes up those acquisition costs. Okay, there's going to be some cash in there, like cash you put out to acquire the thing. You may put out some shares. Okay, so you've got a number, just break that down. Okay, I got a share or a cash component. You may put out some shares for it, so there's a share component. Maybe put out some options, whatever the case may be. But one of the items might be that there's an FIT bump up in there. Okay, and what you'll need to do is adjust for that and take that adjustment out. Okay, because under IFRS, as I said, you wouldn't have normally recorded that. And there's no exemption under IFRS for asset acquisitions. So you can't say, oh, that was done in the past, I don't need to worry about it. Okay, so you need to basically go back to the beginning of time. Okay, but of course you don't want to go back to the beginning of time and look at every acquisition you've done. But if you start at your transition date balance sheet and look at the mineral property acquisition costs, and you look at if you have an FIT liability, and just work backwards from there. I mean, if you did record a bump up, but then you wrote the property off, a few years later, and if there's nothing sitting on your balance sheet at the transition date, then you don't need to worry about it. But any acquisition costs that you do have, you need to have a look and break it down and try and figure out what makes up those numbers, so you can figure out if you've got the FIT in there. Okay, so kind of that's a big change, and definitely that for many of you that might be one of your adjustments at the transition date. Backing up to the second point, I mentioned on the business combination slide that you have to expense your acquisition costs. Okay. On the acquisitions, if it's an asset acquisition, you can continue to capitalize them. Okay, so there's a bit of a difference there. So if you've capitalized in the past, you don't need to worry about that. That's fine under IFRS. It's just the FIT bump up that you need to look at. So maybe I'll leave that at that. We may have questions at the end about business combinations and asset acquisitions, but and we'll field those in a little bit and just keep going along here. Erez, you can take it.
Foreign exchange, probably in accounting, one of the most convoluted sections out there in the handbook, and for good or for worse under IFRS, it's continuing to be convoluted. Just to know truth, but how many people here have taken a foreign sub before if you're going through an accounting exercise and you translate it to Canadian dollars and US dollar, and then you look at the foreign exchange amount that comes out of it and go, oh, that can't be right. I mean, truthfully, have you ever looked at that number and realized that doesn't make any sense, but that's how I have to translate it? Well, it's not changing under IFRS. You're still going to have that probably same confusion. The most important thing to note under IFRS between Canadian GAAP, this is a bit of a busy slide, is that the whole concept of integrated versus self-sustaining is no longer applicable. Canadian GAAP typically says that if you've got a self-sustaining operation, that means the subsidiary can really operate by itself without the help of the parent, use what's called the current rate method. And if you have an integrated operation, i.e. the subsidiary really needs the parent company for its funding and its day-to-day activity, then you use what's called a temporal method, which means that you translate your non-monetary items at historical rates rather than spot rates. So what IFRS really does, it doesn't change the method of translating subsidiaries into Canadian or US dollar or whatever reporting currency you have. But what it does do is it focuses more on the functional currency of the entity. Okay, so it broadens the definition of which subsidiaries you're going to use a current rate method or not. So if you have a subsidiary in Argentina, okay, and it uses the Argentina peso down there to translate, but the functional currency is the Argentinian peso, and all the transactions are denominated down there, even though it's dependent on the parent for finance, you may use the current rate. So that's all I'll say about that, because I find this section to be, if you're having sleep problems, by the way, it's a great one to read. I always, before presentations, I always think, oh, I get a little nervous and I want to have a good night's sleep. I read this section last night, but I had a great night's sleep, so something to consider. But so on foreign exchange, if you have subsidiaries, foreign subsidiaries, at the time when IFRS comes along, come talk to us, and we have to look at how you're translating those subs and make sure it's still applicable under IFRS. Share capital. Share capital is probably one of the few accounts where there aren't significant differences between IFRS and Canadian GAAP. When you issue your common shares, you're going to value them based on your market price or based on the cash value that you've received. What we are seeing more and more, not only in Canadian GAAP but under IFRS, is the break out of the warrant component of a unit. So typically we issue a unit that has a common share and a warrant to it. Under IFRS, the difference between that and Canadian GAAP is that you must use what's called the residual method rather than the fair value. In Canada, sometimes we take the warrant component, we put it into a Black-Scholes model, and just get a number. Under IFRS, use the residual. And what that means is that you value the common share portion, and then the residual, i.e. the leftover, goes to the value of the warrant. We don't view this as a huge concern, because if you do book a value for the warrant, it's all within equity, so it's either share capital or contributor surplus, what will now be called reserves. Share-based payment, that can be a big one for most, probably people in this room. The biggest reason why it's going to be big is because the way you're going to calculate stock-based compensation will likely be different for you. Canadian GAAP currently allows for two methods. One that's called the straight line method, which effectively means you put your variables into this Black-Scholes and it spits out this value, and you amortize that expense over the vesting term of the option, for example. Or Canadian GAAP also allows what's called the graded vesting method. And the idea behind the graded vesting method is that you calculate the same expense, but the way you amortize it is not based on the vesting period. It's based on the graded vesting. Effectively what that means is that you take a lot more expense in the first periods. So if you have $1 million of stock-based compensation, your biggest portion will be in your first quarter and it'll wane down. It's a mathematical calculation. The issue is that IFRS only allows for the graded vesting. So you can't use the straight line method anymore. So your variables and your inputs that you're going to put into that spreadsheet are going to be the same, but the way you allocate the expense is going to be different over different periods. And most companies in town do use the straight line method, which is not accepted under IFRS. So that's the biggest difference. If you're using graded vesting currently, then you're okay. So the impact that could be on transition is that if you've got stock options out there, which most companies do, and many of them are unvested, then you have to recalculate and see if there's a material difference. And just a note, if under your stock option plan, all your options vest on grant, okay, there is no difference between Canadian GAAP and IFRS. Because if they all vest on grant, you just expense it all right away. But if you have vesting provisions, then as a date of transition, we're going to need to look on what portion of the expense has not been included in the income statement that's unvested. So what to get out of this slide is really to look at what your unvested portion of your options as a transition date, and know that for future stock options, you're going to have to likely calculate them differently. So one of the things we're always telling people, we're starting to tell people, is that if you're going to grant options now, i.e. in 2010, why not use the graded vesting now? Because it's acceptable under Canadian GAAP. You can do so. So if you account for it as such now, then on a date of transition, you don't have to go back.